Howdy, Jacob here. Just want to say happy holidays to everyone. Today we're looking at International Paper Company, company number 76 in our dividend yield screener. Let's look at some of the financials here. So $12.7 billion market cap, $17 billion enterprise value, currently a 5.06% dividend yield. Let's look at some of that debt right now. Okay, so they have bought down quite a bit of debt, which is good to see. Looks like between 2012 and 2017, they went from almost 12 billion to over 17 billion in long-term debt, and have since dropped down to 4.8 billion in their long-term debt. They have about 800 million on cash right now. Let's look at some averages of free cash flow. So we look at 2022, we're looking at about 1.2. 21 is 1 point, almost 1.6, 2.3 mil, 2.4 mil. Okay, so we can say that maybe a 5 year average is just under 2 million. And right now, with their long term debt of 4.8 million, that is a comfortable level. They shouldn't be too concerned with that as long as they don't go back into the debt situation they had in the 2016 2017 era. But they have been doing very well the last couple of years at just destroying down that debt. So that's good for them, especially moving into what's likely going to be a higher interest rate environment than the previous decade. That's something good to see. And looks like they've also been buying back quite a bit of shares. Had about 443 million outstanding in 2013 and are down to 364. So that's a bit of buybacks there. As for the business and growth potential, it doesn't look like there's really any growth potential. We have 23.5 billion in 2013 and down to 21.2 billion in 2022. Let's see, was there? Okay, so huge um, devastations 2013, 2014, then 2020, 2021. Okay, you don't really see that in the interesting. So this might be a business that really doesn't grow, which there's really nothing wrong with that. Um, and then I'm putting 10 on the P price free cash flow because no growth business with no moat or really deserving of being higher deserves about a 10 on the PE side. And 15 on the discount rate. Let's look at some of the margins here. So let's see, 7%, 8%. Might just put, let's do 7%, 8%. Share buybacks. They've been buying back quite a bit of shares. Let's say they buy back 2% of shares. We didn't look at the dividend. Let's see what that is payout wise. 646 million. Pretty reasonable payout for the company that's producing almost 2 billion on a 5 year average free cash flow basis. I think let's see. It's like the last 2 years they've dropped it a bit, but historically, I mean, I think they could grow that at 3% for the next 7 years. That's going to put them still under that 50% payout ratio, and it looks like they are using cash to buy back shares and to buy down a little bit of debt. But they have bought down their debt quite a bit recently, so they might even have a higher payout ratio. But for me to be conservative, I'm just going to assume 3% growth on the dividend side, 2% in the share buybacks, and then with the remaining, the balance between maybe making acquisitions and paying down debt. But for now, this has us with a price that is needing to drop 29% given the following assumptions to make a 15% return. For me, this is a company that seems pretty interesting. I mean, there's a few reasons companies have as high dividends as they do. If you look at all companies with a lot of dividends, one is um, they're a very volatile business, which we see in like some of our oil companies where the price of oil is so dependent on, or their earnings are so dependent on the price of oil to where some years are just great, so their dividend yield looks so big because they're just handing all the cash back to the business or the shareholders, and then On down years, it might not do so well. And then you have consistent dividend companies where it's more so common in companies that have little to no growth potential ahead of them. I see nothing wrong with owning a company that doesn't have a lot of growth ahead of them. It's really just whether the company does a good job of allocating the cash that they have before they become a dying. Hey, you hate to say it, and every company hates to say it, but a dying business where they're really just using out all the assets that they have um, till there's nothing left, and then doing the best they can to give money back to their shareholders. And so, again, there's nothing wrong with them using dividends and share buybacks to maximize company value for no growth businesses. You can definitely maximize returns. Obviously, buying a company that has a lot of growth ahead of them, a lot of compound growth ahead of them is pretty great. But that's not to say you still can't get a great investment from a company that doesn't really grow due to them handing back 5% on the dividend yield and buying back 2% on the share buybacks. If you buy it cheap enough, the stock should still go up. And so for this company, um, it fits our criteria on the dividend side. It has over 5% dividend yield. But for me, with little to no growth potential ahead of them, I'm just going to be waiting for it to get to a price that looks more attractive, and then doing a deeper dive once it does to see if these assumptions make sense. So, yeah, I hope everyone has a great holiday weekend, and hope everyone enjoyed the video. Thank you.